about to leave, already packing. Come with me, I'm not really asking. We'll get away to a place where we don't know. About to see the world in action, what we can be, life with no distractions. We'll get away, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out, die with my own doubts. Be free with me. Let's go, let's be free with me. Be free. Not looking back, eyes on the freeway, Bonnie and Clyde, a classic cliche. We're on the run, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out, die with my own doubts. Be free. Let's go, let's be free.
Good evening, everybody. John here from Tutor to You, welcoming you along to another of our exam skills live sessions. Massive welcome to those of you who are watching us live. Let me have a quick look at the clock. It's good to see so many people joining us. Big welcome to you, and also big welcome to anybody who's watching this on catch up on replay, as we know hundreds and hundreds of people have been doing. If you are watching on replay, of course, you can slow this whole thing down by pausing at those points where you need a little bit of time to think. If you are with us live, though, please do join in by giving us some thoughts and some answers to our questions as we go through them, by putting your answers into the chat window. And we're talking about central banks and the operations and functions of central banks tonight. And I'm joined by two of our most popular presenters. Welcome to Kathy in the middle of the screen and Isabella
Hello.
on the right hand side. Good evening, both.
Hi, how are
Good
you?
evening.
I'm very good, thank you. Right, I think we're ready. So shall we get started, guys?
Yeah, why not?
I'll hand over to you.
Right, so I'm starting us off tonight. So, central banks have many roles. Which of the following is a role of the Bank of England? So you need to read the question carefully with multiple choice questions. Think what you expect the answer to be. Have a look for it on the list. And when you think you've got the right answer, do just type it into the chat for us and we shall see who can get this right today. So, central banks have many roles. Which of the following is a role of the Bank of England? Is it to directly influence the monetary policy of the EU and the USA? Is it to intervene in the foreign exchange market in order to manipulate the value of the sterling? Is it to be a banker to the UK government? Or is it to set all interest rates in the UK? Okay, we've got people straight on this. We've got a lot of people saying that they think it's D. Does anyone think it's anything different? Oh, Moazam, I hope I'm pronouncing that right. If I'm not, if you could type it phonetically in the chat, that'd be great, and I'll get that right next time. So Moazam, you've gone for C, so you've gone something for slightly different. But HCC, Vern, Orin, Eliza, Will, Misbah, Jade, Cormac, you've all gone for D. We've got a B as well in there. Okay, so we've got a bit of variety here. No one's gone for A, but we've got at least one person for each of the other answers. Let's have a look what the correct answer was here. It's C. Now, I think the trap that a lot of you have fallen into is a very common one. So all interest rates in the UK, well, of course, there are lots of interest rates in the UK. Each bank has different interest rates, but even within a bank, you might have one rate for a credit card, one rate for a savings, one rate for mortgages. So there are lots of different interest rates in the UK. And the Bank of England is responsible for setting the base rate or the bank rate, but it doesn't set all of those rates. So be really careful with that one there. It was designed to put in there to put you off. And the actual answer is C, to be the banker to the UK government. Now, there are other roles of the Bank of England. Some central banks might intervene in foreign exchange markets directly, but the Bank of England doesn't do that. That's not one of their functions within the Bank of England. But some central banks do. And of course, the Bank of England isn't going to be directly influencing the monetary policy of the EU and the USA. They have their own central banks to do that, the ECB and the Federal Reserve. So the answer there was C. Tricky one to get you going. Let's have a look at the next question. Okay, so following the financial crisis of 2007 to 2008, the credit crunch, and the onset of recession, the central banks of the US, UK, Japan, and the EU used quantitative easing, QE. I can never say that right. Quantitative easing. And they used that to help stimulate the economy. Now, what does QE tend to involve? Is it the takeover of financial institutions by the central bank? Is it the selling of government bonds by the central bank? Is it the buying of shares on the stock exchange by the government? Or is it the buying of government bonds by the central bank? What do we think there? And who was first in this time? I think it was Will that was first in this time, closely followed by Misbah and Merzam and Rosie. So we've got 4 Ds in a row here. Anyone else for a different answer? You're in year 12 and don't know what quantitative easing is? Don't worry, you can come back to this next year if you haven't studied this yet. So don't worry too much about it. But everybody that has answered has gone with D. Let's have a look at what the correct answer was. Yes, so it is D. So the way I remember it is when they buy, they make the money supply bigger, and when they sell, they make the money supply smaller. So buy big, sell small. When they buy government bonds, gets bigger, sell makes it smaller. So that's just one way to remember that. Keep that in mind. Oh, lots of people getting that one right here. Okay, let's move on to question 3. So the role of the Financial Policy Committee, or the FPC, is to what? Is it to identify and monitor risks in the financial system? Is it to set central bank interest rates? Is it to issue banknotes? Or is it to protect consumers' savings? Now, if you haven't studied this yet, don't worry. Just take a guess if you're not sure. If you were in an exam, what would be your best guess? Remember, we never leave a multiple choice question blank because you've always got a 25% chance of getting it right. Let's have a look here. So Athena has gone D. Actually, I think that might have been the last question. So we've got Marzam, he's gone for A. Orin, also A. Henry A. Cormac A. Woke A. Will A. Okay. Anyone willing to go out there on a limb and go for anything different? Or do we all agree that the answer here is A? Lots of people joining in tonight. This is fantastic to see. Putting themselves out there. Okay, let's have a look. What is the answer? Yes, it is. It is A. So it's to identify and monitor risks in the financial system. Okay, and then our last multiple choice question for the day. Okay, so if a country's central bank buys financial securities, bonds, corporate on the open market in order to increase the country's money supply, this is an example of, is it open market operations? In financial relation, the central bank as a lender of last resort, or financial intermediation. So those are all phrases that you might have heard before. Is the correct description in this case? It's an example of what? Let's have a look. It's a bit harder. You've got to get your head turned. What do we think? Henry's gone with D. Any more for any more? Just take a moment to read through it. What do you think? Corporate bonds, the open market. What is that named? I think we're finding this quite difficult. See the answer. See what we can learn from it. Should we have a, it is in. So this one's A. So who said? So Rosie said A. Orin said C. Oliver said C. Rosie said D. And then Cormac said C. And Jade said C. So we've had lots of different answers here. So maybe this one's a bit one that we're finding tricky. Now, actually, the clue's in the title. It's open market operations. It's not increased financial regulations. That tends to be when we put limits on private banks and commercial on our kind of private systems to check that things are going all right. It's not them acting as a lender of last resort because they're not giving banks money when they can't find loans elsewhere. Just
Okay, guys.
sounds sensible, so it's probably a fairly good guess here, even if you're not sure. Oh,
Yeah.
can you hear me?
Yeah, hi Isabel. We're having a few problems there. Your voice was cutting in and cutting out. So we'll move on to the next activity then.
You missed my great explanation.
Go for it again then. Sorry, go on, Isabel. Go for it again.
Okay, John, let me step in. I don't know what Isabel was going to say, but I'm guessing here that when she said the clue is in the question talks about the central bank buying financial securities on the open market. That's why these are called open market operations for that reason. So apologies, Isabel, if that was not what you were going to say, but hopefully that's helped a little bit.
Thank you, Kathy. Yeah, well, just before we move on, Isabel, are you back with us?
I think I'm here. That was a great explanation, Kathy.
Yeah. Okay. Right. Okay, we'll move on. Thank you, Kathy.
All right, so it's over to me now to one of my favourite activities, the Data Lab activity. So this is where we get you to analyse some data. So John, if you'd like to bring up the screen for us, please. So here what we've got is the CPIH in blue. So hopefully you're all familiar with what that is. One of the consumer price indexes with rather more housing costs in it than the CPI. So that's in blue. And then we've got base rate or bank rate in the orange. This is the rate set by the Monetary Policy Committee. So what we'd like you to do is to compare the UK inflation and base rates before 2007 and the relationship afterwards. And what I'd like you to think about is why the relationship seems to be different. So if you can just add some quick thoughts to the chat, that would be brilliant. So why are we looking at a relationship that seems to have changed quite significantly? Oh, looks like we get a minute to do this. We're 15 seconds into it. Halfway through. And I can see some answers are coming in. Yeah, lots of people saying this is to do perhaps with the financial crisis. Lots of people are thinking that. It's a mere mention of 2007 is enough to make you think that, isn't it? Okay, that looks like it's time up. I didn't spot that little clock. John's going to have to put bigger clocks on these slides for me to notice. All right, John, do you want to put up on the screen our thoughts on this, please? All right. Well, if we look at this chart, so before 2007, interest rates appear to have a positive relationship with the base rate. So as inflation increases, the base rate seems to increase and vice versa. And that's pretty much what you would expect. So the unusual relationship is actually after 2007-8. So I think you're absolutely right in identifying the financial crisis as something that's happened here, but also we've had quite a number of economic shocks since then as well. So the Brexit referendum in 2016, if my memory serves me correctly, then of course the pandemic. So we've got the Monetary Policy Committee much more reluctant to raise interest rates because of the impact that that might have on economic growth. So I just wonder if people would like to add to the chat. Now, I don't think this chart here, if my eyes are serving me correctly, and they may not be because I missed the clock altogether, I don't think this chart's got the latest figure for base rate on there. So just super fast, add to the chat what you think base rate, the latest interest rate set by the Monetary Policy Committee is. So I've got a bit of a lag. Apologies if I don't see yours straight away. Yes, coming in absolutely correct. It's 0.5 is the current rate. And we've got the next meeting of the Monetary Policy Committee coming up on the 17th of March. So it will be interesting to see what they do then. At this most recent meeting, 4 out of 9 members of the Monetary Policy Committee wanted to put the rate up to 0.75. So they wanted to do more than in fact happened. And all of this, of course, happening at a time when there are warnings of really, really big squeezes on disposable income. Right, let me hand back to Isabel now. Hopefully we'll be able to hear her this time. Isabel, back to you.
Can you hear me?
I can hear you.
Loud and clear.
Hurrah.
Loud and clear.
Okay. I'm back in the house. I'm back on. Okay, so we've got 60 seconds. You've got to separate the key phrases into which are related to expansionary monetary policy and those which relate to deflationary monetary policy. So the way we're going to do this is I want you to type in the numbers of those phrases that refer to expansionary monetary policy. So if you're with us here today, I want you to type in numbers of the phrases that relate to expansion. And you can get those down there. But I'm going to give you 60 seconds. Off we go. Oh, Pedro went straight for it. Even before we'd started, he was on it.
It's definitely the A team today, isn't it, on the chat?
Gonzalez. Certainly. And we've got a bigger clock on this one, yeah. Everyone can see.
Even I wouldn't have missed this.
So really confident in these answers here. Everyone's saying the same ones. Let's see if they got them right. Let's take a look. Yeah, so we've gone in a bit of a strange to me. So you guys have gone in numerical order. We've gone for a fall in nominal and real level of interest, measures to expand the supply of credit from the banking system, and the depreciation of the external value of the exchange rate. So those things are what we associate with expansionary monetary policy. That's if we want more demand in the economy. Now be careful, because expansionary generally means making smaller interest rates. So just because it's expansionary, it's not the interest rate that's expanding, it's hopefully the economy that would be expanding there. Fantastic. Okay, I'm going to hand you back over to Kathy for my favorite, the bubble quiz.
I know. The only thing better than a bubble quiz were the bauble quizzes, weren't they? Right, John, could we have question number 1, please? Now, if you're new to this, you'll know this isn't like multiple choice where there's just one right answer. There could be any number of correct answers. So the question then, which of the following are roles of the Bank of England? Supervisor of the commercial banks, banker to the government, manager of the government debt, and lender of the last resort to the commercial banks. So which of these, remember, it could be any number of them, are roles of the Bank of England? So I can see lots of people. I've got B and D, B, C and D, B and C, B, C and D. Someone's got all of them. A, B, C and D. Oh, this is really interesting. Several people saying, oh, John, would you like to give us the answers? Okay, so some surprises here then. Well, A, of course, is correct. The Bank of England is the central bank. It sits at the very centre of the banking system, and it's got lots of supervisory responsibilities. It is the banker to the government, so that was one of Isabel's multiple choice questions. Let's do D first and we'll come back to C. So it is the lender of last resort to the commercial banks when they run short of liquidity on any particular day and they can't borrow from one another, but they are fundamentally sound. That's when they can borrow from the Bank of England. Now let's have a look at C, manager of the government debt. Well, this in fact isn't the Bank of England. Since 1998, this has been the Debt Management Office. Now, if we were to go back before that time, it would have been the Bank of England, but it's someone different that does it now. So I'm going to question slightly them being the manager of the government debt, because actually it's the Treasury that tells them how much money they want them to raise each year selling government bonds, and actually they give them quite a lot of instructions as to the type of bonds they want them to sell. So do they want, what maturity do they want them to be, and what proportion of them do they want to be index-linked bonds? Index-linked bonds are rather clever things where the interest rate and the final value you're getting back is linked, is index-linked. So well done if you got that right. Let's have the second one, please. So which of these are functions of the Bank of England? Is it maintaining the external value of sterling? Is it maintaining the integrity of the currency? So I take this to mean domestic currency here. Is it maintaining the stability of the financial sector? Or is it setting bank rate in the Monetary Policy Committee? Do remember, any number of these could be correct. So if you want to enter onto the chat what you think are the right answers, that would be brilliant. Just give you a little bit of time. Someone saying B, C, and D, which is good. Let's see whether other people agree. A, B, and D, D and C, B, C, and D, all sorts of different things coming in. Seems to be a fair number of people, though, think it's B, C, and D. Just give you a few moments more. And John, do you want to just show us the answers? Okay, there we are. So the answer that's incorrect is maintaining the external value of sterling. Now, again, if we were to go back a number of decades, then the Bank of England did intervene in the foreign exchange markets. And I can remember when I worked in the Treasury, one of my jobs first thing in the morning was to come in, ring up the Bank of England and ask them how much activity they'd undertaken in the foreign exchange markets overnight, but not any more. All right, let's have the last one of the bubble quiz questions, please. So, which of these are genuine central banks? The Bank of Canada, the Bank of Japan, the US Federal Reserve. Now, hopefully, you were listening to Isabel earlier on that one, and the Reserve Bank of Australia. Which ones here are genuine central banks? C for sure. I've got all of them, all except A. C and D, so real mix of answers again. Cheated to you, just reminding it could be none of them, but if that's true, Isabel was not telling the truth earlier in one of her answers, because she definitely mentioned one of them earlier as being an
Maybe I was being
example of a...
sneaky.
Yeah, but maybe you were being sneaky, Isabel.
Maybe
Maybe
I
you
was.
were. Yes, need to keep everyone on their toes. John, do you want to give us the answers? And of course, it is all of them. So very, very well done if you got those right. So Isabel, back to you, I believe, for your next activity.
It is indeed. And I get a kind of sense of excitement when all four on the bubble quiz are correct. I don't know what it is. I get so excited when that happens. It's a rare event. It's a rare event. Okay, so we're going to now look at on balance. Now, it's really important that you can see both sides to economic decisions and think why it might be good, why it might be bad. A very, very important exam skill for you to have here. So today we're going to be looking at negative interest rates. So we're going to start with looking at one reason. Can you give me one reason that we should be using negative interest rates? Can you think of one reason that a central bank might set negative interest rates? This has been something that probably wouldn't have come up in an exam maybe, I don't know, 10 years ago, but more and more common. We've seen it in Japan, we've seen it in Sweden, we've seen it in Switzerland, we've seen it in Denmark. So negative interest rates. Why might we want to set negative interest rates? Oren's come straight in there. So Oren has said to encourage consumers to spend. Eliza said to encourage investors. So we've got a couple of things coming there. Any other reasons? Any other reasons why we might want to use negative interest rates? Really interesting one. Haha, did you get it? Interesting. There we go. I'm here all week.
Oh dear.
Okay, so Pedro said that it boosts investment and spending. Woke Pope said that it promotes consumer spending and GDP. I like the fact that you've got a bit of a chain going there. Grace has said in a recession. She's given us a time when we might want to use it. Athena, to prevent deflation. Let's have a look. What have we got for some possible reasons? Now, these aren't the only ones. These are just a couple. Okay, so using slightly longer chains, I think generally they're going to result in the same outcome, but we've given slightly longer chains here. This will cause this, will cause this, and that's a great thing to show in your exams. So they'll cause an outflow of hot money, thereby depreciating the exchange rate. So foreign people who have money invested in British banks, if it's now a negative exchange rate, that's not a great deal for them. They'll go elsewhere to find a better exchange rate, and in doing that, they'll want to get rid of their pounds. And it also gets banks lending. So they'll pay the central bank interest for holding money on deposit with them, so that it will hopefully encourage banks to lend money out rather than keeping it for themselves. And that will then end up in the results you said, which are hopefully increased investment, increased spending, preventing deflation and promoting some GDP growth, which is what we would want there. Okay, let's have a look at the other side. We've already got some people coming in here. We're a very enthusiastic bunch tonight. I'm loving the team that are on the chat tonight. Really, really good. Okay, negative impact from using negative interest rates. So negative impacts about negative interest rates. What's the other side of the scale? How can we balance out what we've said? What might be some negative impacts? So we've got a couple here. So it's a risk for the bank's profitability. Extremely low interest rate can lead to the creation of zombie companies, firms which are unable to pay back their debt. I love that phrase, zombie companies. It always makes me think of horror films. So it can dampen productivity and economic growth because it's a drag. Oh, loads coming in. Really, really good answers here. All sorts of problems here. Let's see what we got. So the economy may become dependent on these ultra low interest rates. And that links to what Will has said about these zombie companies. Would they survive if they had to be a bit more profitable? So are they just using our resources in the economy, not really making, which that is going to reduce productivity? Pension and insurance companies may struggle to meet their long-term liabilities if those long-term interest rates are close to zero. Low zero obviously depends on the real values. As early as they were going to, which means they stay in their jobs for longer. Maybe they aren't as productive anymore, although you could argue that they are more productive. But it takes jobs that then the younger generation then can't move through those jobs. So there's also an issue there of intergenerational equity. So really interesting one. I think I might be cutting off. I'm not sure, but I'm going to pass over anyway.
Yeah, I think you're back now. There was a dicey moment in the middle there, but certainly I heard you at the end. Right, this is my final activity here. This is the evalue wheel. This is where we're going to give you a line of argument, a line of analysis. And what we would like you to do is to add in the evaluation. So, John, would you like to give us the students' arguments? So first of all, then, a fall in interest rates will lead to a depreciation of the exchange rate. A cheaper domestic currency will increase sales of exports. Now let's spin the evaluation wheel and see what phrases we need to start our evaluation with.
I'm hoping for yellow.
Are you?
I'm hoping for yellow.
I'm hoping for orange to match what I'm wearing. And we'll go with that being silver, shall we, rather than grey. All right, so we want some evaluation then that questions the validity of the assumptions that underpin the economic theory used. I can't see a clock before I make a mistake on this.
No clock this time, Kathy.
No clock this time. Right. Give yourself just a few moments then. See what you can add to the chat. So what could you say that questions the validity of the assumptions that are made here? Add them to the chat as soon as you're ready. I've got a bit of a delay here, so apologies if you are typing away. I can't see anything coming through yet, but I'm super excited because people on the chat are doing so well this evening. Let's give you a little bit longer. Right, so somebody's saying the assumption here is that there is actually demand for exports in the first place. Someone's mentioning the J-curve effect. People talking about the elasticities. They're all really good stuff there. John, do you want to bring our answer up? So the answer we've got, so this was very much the point made by someone on the chat. This assumes that importing countries have economies that are growing or are in a position to increase their demand. I've just been scribbling down. I think there are so many things you could say here. If we start with the first sentence, well, this is actually assuming, first of all, that other countries' interest rates haven't changed. So if they're all moving together, then you're probably not going to get this effect on the exchange rate in the first place. You might also say it assumes that your non-price competitiveness is good. So in terms of people wanting to buy your exports, it may not just be down to price. You've actually got to be exporting things that people are actually interested in buying. So super well done, everybody. John, here we go. The activity that Isabel and I look forward to.
As you should, as you should, Kathy and Isabel, because it's the one you're both so very good at. Those of you joining us live, and if you've joined us before, and I know loads of the names coming up tonight I've seen before, you know how we finish off our exam skills sessions by these quick shot in the dark questions. So you're not supposed to know the answer. The idea is for you to use some intelligent guesswork as a way of trying to think up what the answer could be. And we pit your wits, those of you who are watching live and those of you who are willing to tell us what your thoughts are in the chat window, against the great expert minds of Kathy and Isabel, who don't know what the question is and therefore don't even know what the answer is. But they'll have a go.
Really don't know what the question is this time. We really don't.
Absolutely not. Although we've referred a little bit to it as we've been going through tonight. So let me just put the question up on the screen for you and everybody else. The highest base rate of the experience in the UK over the last 50 years, so in my lifetime, obviously you guys are much younger than me, over the last 50 years was 17%. So we talk about interest rates at the moment going up. It's 0.5 at the moment, but the highest was 17% back in 1979 stroke 1980. What was the highest real interest rate during that same period? Now, I've tried to give you a little bit of a clue, obviously, by stating the actual interest, the actual base rate, the highest being 17%. So hopefully that gives you sort of like a band from which to work on here. So while Kathy and Isabel having a little bit of think about that question. Hopefully you guys are doing exactly the same at home. Please don't just look it up on the internet. The answer is there, but it's sort of going against the spirit of things. Remember, the real interest rate is interest rate that takes into account inflation. So basically it's the difference between the nominal interest rate and the rate of inflation. What is the largest rate? We've already had one entry. Thank you to Zach. Zach's come in with 12.5. Let's see what Isabel and Kathy think. Kathy, we'll start with you. What do you reckon here? What do you reckon?
Oh, it's never me that goes first.
Well, it is tonight.
I really don't know. I don't think it's as high as 12.5. So inflation's got to have been very high to have interest rates of 17%. I am going to go for 6.
6% goes Kathy. Okay, so just remember, to those of you who are having a stab at this one, this shot in the dark, it's the difference between the nominal interest rates, and the highest we've ever had is 17%, and the inflation rate. So that gives you a little bit of a thing to think about. What do you think, Isabel? Kathy's gone with 6%.
Oh, I was going to go 6. Okay, I'm going to go for 7.
7? You're going to go with 7. You'll go with 7. Okay, and just having a quick look on the screen here. Grace has gone with 11.2. She started with 5.8 and then went to 11.2. Matthew's gone with 6.9. Oliver's gone with 2. Isaac's gone with 14. Grace now, I think she's come up with the definitive answer. Has to be 5.8. Grace, you are so convinced. Absolutely brilliant answer. Not right, but a brilliant answer all the same. It's all a shot in the dark. 6.9. I'm going to give that one to Isabel. Isabel said 7%.
Isabel.
Although we did have one person, of course, go with that exactly 6.9. Brilliant stuff. Wonderful stuff. Brilliant. I love that one. I love the way that we always finish off with one of those shot in the darks. Brilliant stuff again, guys. What I've been incredibly impressed with tonight is the quality of the answers. We've been having some good answers over the last few weeks, but tonight it just seemed to have gone that little bit further. Lots and lots of answers coming in for the shorter ones, and then some really good quality answers for the ones where we've actually sort of open questions. Brilliant stuff. Massive thank you to Kathy and Isabel for helping us to put that together and deliver that tonight. Brilliant stuff as always, guys. We've got one more of these sessions to come before we take a little break over half term. So we're on again next week, where we'll be discussing the national minimum wage. I think you're joining me again, Isabel. That's right, aren't I?
I am. Hopefully I will be, you'll be able to hear me next week.
Good stuff, yeah. And we'll see Kathy again in the not too distant future. I'm absolutely sure of that fact. Don't forget, guys, if you've enjoyed tonight's session, please do give us a like on the on YouTube. That helps us get our message out to as many people as possible. And of course, you can download the PowerPoint presentation that we've been using as the evening's going on as soon as I've pressed the finish button in a few moments' time. And of course, you can watch this video all over again. Massive thank you to those of you who took part. I should name some names, shouldn't I, really? Orin, Eliza, Will, Masbar, Jake, Favour, Rosie, Athena, Henry. I can't read some more writing there. Big thank you to Pedro, I think, who was the first in with the Data Lab answer. So well done to those of you who did take part. We'd love to see you again next week. Until that time, then, we'll say good night. Goodbye, everybody.
Right. Bye.